I want to thank the Development, Climate, and Sustainability Department for sponsoring this event, especially the lunch. This is one of those cross-cutting issues that could be in any of the departments that you're studying in, because it's states, markets, and institutions, economics and finance, and everything in between. But I think it's a perfect day to have a panel on ESG. It's 86 degrees out there, and it's early April. This is not a joke. It's also the 10th anniversary plus 1 day of the Rana Plaza tragedy. So those are all ESG issues. I see people nodding. They know what it is. That's great. So my name is Nina Gardner. I'm an adjunct professor here at SAIS. I've been teaching corporate sustainability, business, and human rights for over 10 years now. And because of the uptick in this field, I'm starting a ESG skills course tonight. So those of you who are signed up, I look forward to seeing you later. But I can't think of a better group of people to be talking about demystifying ESG than who we have here on our panel. As you know, there's been an uptick in ESG in all walks of life. Even law firms now are focusing on ESG as a compliance issue. You see, of course, investment firms, obviously. It's been in the daily of New York Times, so you know it's gone mainstream. But ESG is an investment discipline, and so if you're concerned about environmental issues, so think greenhouse gas emissions, plastics, water, or social, which I hate the term, but that means human rights and health, like health and safety of workers, and governance, like corruption and other issues of that nature. This acronym is trying to capture risks to companies. Now, this acronym seems to be everywhere nowadays, and people use it interchangeably with sustainability, CSR, et cetera, which gets my goat quite a bit. But there is clearly, however, a sentiment that business sectors, especially global companies, have to pay greater attention to maximizing, or have to go beyond maximizing short-term profits for more long-term goals to bring financial return to their investors. Now, we're going to be talking about that. Many firms create ESG funds as vehicles for their clients to invest in companies that are protecting people on the planet, and through them you can do well as good. And based on this, ESG funds have grown dramatically. We'll hear from Bryan on that. Since the term was coined in 2004 and started at the UN Global Compact, now we are counting more or less $35 trillion globally. That is a third of total assets under management in the US and Western Europe. So without further ado, what we're going to do, I'm going to quickly introduce our three panelists and then have them make a few sort of 5-minute worth of comments. We'll have some Q&A, and then I hope all of you will be joining in the Q&A as well. I'd like this to be a robust conversation. So we are very honored to have Jade Huang, a SAIS graduate from in International Finance and Economics from 2005, correct? And a Berkeley grad. And you're Vice President ESG Portfolio Manager at Calvert Research and Management. And you have been there since 2006, and you started as a senior equity analyst. One has to start somewhere, and this is that was a pretty good position to start. Before, she was an investment analyst at Microvest, an asset management firm specializing in impact investing, which is different from ESG, and maybe you can tell us a little bit about that. And you led the certification department at Fair Trade USA. Macani Toungara is a lawyer from Georgetown Law and a graduate of the Woodrow Wilson School of Public and International Affairs. We won't hold that against you. Macani, it's okay, you didn't go to Johns Hopkins, but, and you're the Director of Social and Environmental Responsibility at Dell Technologies, where she manages Dell's social environmental responsibility assurance and engagement programs. Huge job, folks, huge job. Prior to that, she was senior advisor at USAID in the Africa Bureau. And prior to that, she was manager of international programs Africa at the Obama Foundation after 8 years at Technoserve. So wonderful career as well, touching on in lots of fields. Last but not least, Bryan McGannon, University of California, San Diego grad in political science, and serves as U.S. SIFS for a few more weeks as acting director of U.S. Sustainable Investment Forum, but is normally managing director. And U.S. Sustainable Investment Forum is the lead representative, advancing the interests and perspectives of sustainable investment community with policymakers and stakeholders, which is starting to become, take some super heavy lifting these days as the headwinds are getting stronger. Prior to U.S. SIF, Bryan was, spent 20 years in policy and advocacy, most recently as a policy and engagement director for the American Sustainable Business Council, and has been a real force on many presidential campaigns, congressional races, and local ballot initiatives. So it'll be very interesting to get the political side of things from Bryan. But first, we're going to start with the nuts and bolts. Jade, give us the sort of ESG overview from an investor perspective.
Okay, great. Well, first, thank you, Nina, and it's an honor to be back at SAIS. As Nina said, I am an alum, and I did my first year in Bologna and the second year in DC. So it was really nice to be back in my old stomping grounds. So I have been at Calvert since 2006, so pretty soon after I graduated from SAIS. And for those of you who aren't familiar with Calvert, we are an ESG asset manager. We've been around for over 40 years, and all we do is ESG investing. So we have strategies, mutual funds, different strategies that span different asset classes. So we do fixed income as well as equities, and then certainly that span globally across the capital markets. When we do our ESG research, and again, ESG, maybe this is so basic, but environmental social governance research, we are basing it on what we call the Calvert principles. So we take a principles base to investing. And essentially the Calvert principles lays out our ESG framework. So what an underlying concept for responsible investors, ESG investors, is a concept of financial materiality. And that's certainly something that we focus on. And so what that means is that we're looking at the most relevant environmental social governance issues that make a financial impact on the long-term performance of a company. So you might think of, a software company, or, for example, and that's going to be considering very different ESG issues than a metals and mining company, for example. So we'll look at in software, really focus on human capital development. And on the other hand, for metals and mining, for example, we're going to be looking at health and safety issues, but we're also going to be looking at what is your environmental management, how are you working to reduce your greenhouse gas emissions, et cetera. So we use the Calvert principles again, which is our research framework. And that is the lens through which we determine whether a company is investable or not. And then we're also able to, essentially we create models that are rating these companies based on their ESG performance in these financially material areas. And from there, me as a portfolio manager can leverage the decisions that our research team makes about a company, but also their scores, which are all proprietary scores, to create portfolios. So the strategies that I manage, some of them are thematic in nature. So for example, we have a diversity, equity, inclusion strategy, which is entirely focused on companies that span across all the industries across the globe, different countries, and are assessing companies primarily based on their performance in management of diversity across the corporate levels, so at the board level, executive, and then also manager and just regular employee level, but also in how inclusive the culture is, right? And all of this feeds into a broader investment philosophy where we are considering the management of these financially material ESG issues are allowing companies to be better positioned relative to their peers. So if you think about the impacts of climate change, for example, and the risk that that can place on supply chains, or for example, if you are not creating an environment that allows you to attract the best people and retain the best people, the impact on your ability to innovate and continue to create products that most resonate with the market. So we believe from an investment standpoint that companies that are really demonstrating that they're able to do this management, not just on the risk side, but also capitalize on the opportunities in these areas of ESG, that they're going to be better positioned over the long term, and that will translate into stronger financial performance. So as an ESG investor, performance is first and foremost. So kind of this myth that if you are an ESG investor, you're going to sacrifice performance is not something that we believe in, and certainly the performance of our funds validate that we can outperform, and we do outperform over the long term. And we believe that it's because we're investing in companies that are really best positioned relative to their peers. And when you're thinking about some of these ESG trends, long-term trends, those like climate change, like a more diverse society, then companies that are really thinking long-term and managing today for the long term are going to be in a better position to navigate a changing world. So maybe I'm going on really long, but that's generally what we do.
That's a great way to set the stage for now. We'll come back to you.
Yes.
So, Macani, from an ESG perspective, how does a company deal with the kinds of questions you might be getting for investors? How does it drive change, positive change, hopefully, in a company like Dell, which has supply chain issues, always had supply chain issues, and they're trying to probably deal with the best they can?
Sure. Thank
Easy
you.
question.
And it's a pleasure to be with all of you today. So I, as mentioned, am the Director of Social and Environmental Responsibility at Dell. Dell has what I would call a hub and spoke model when implementing our environmental, social, and governance work. This means that at the center of the company, we have a core team, a corporate ESG team that defines the strategy for the entire business. So they're the ones who, identify which areas we want to focus in as a business and coordinate the messaging, and then different business units implement their pieces of it. I lead the supply chain spoke of our ESG strategy as a business. There are other groups such as our product group, which deal with the content of our products. There are other groups that deal with services. So there are many spokes that come out of the corporate ESG strategy. And so we had that team in coordination. And actually the meeting I was in right before this call was a coordination call with the hub and all of the spokes in one room, talking about how we are coordinating and making sure there aren't silos in coordinating the implementation of our ESG strategy. So different companies do it differently, but that's how we do it. I report up through our in global operations into our chief procurement officer. Our corporate ESG team reports up into the SVP of marketing, and they eventually all report up into the chief himself, Michael Dell. The social and environmental responsibility team has a broad mandate to ensure that our supply chain is compliant with our social and environmental commitments. And this has many pieces to it. So starting with environment, we have launched an initiative to drive down emissions from our supply chain. For those of you who are familiar with climate and emissions issues, it's scope 3, category 1. So emissions, from our suppliers, and we have an initiative that's run out of my team that is working with our suppliers to reduce their emissions and their suppliers' emissions so that we can achieve our larger emissions reduction commitments, which I'll speak to in a bit. Our team also enforces human rights commitments. So we have a vulnerable worker policy, human rights policy. We've signed up to all the commitments that ensure that our supply chain is a safe place to work for all workers in our supply chain. And so part of that is, if an issue comes in through our grievance process, we have hotlines and calls where people can call in if they have an issue. Then, members of my team will be involved in responding to that, do an investigation and follow up. And, depending on the issue and if it's not resolvable, there are times when we actually exit suppliers from our supply chain because of violations of our human rights principles. Now, all these principles are embedded in what we call our supplier principles. You can find them on our website. Those principles were designed in partnership with an organization called the Responsible Business Alliance. We are a founding member of this organization of electronics-related companies because we felt it was important as an industry to set common standards for our supply chain so that suppliers could reasonably have a standard to which to hold themselves that all their customers largely would expect of them. So this type of harmonization of policy really allows the supply chain to function effectively and make it easier to have a common standard for what it means to be compliant with the commitments that we've made as a company and that we're doing as a collective for those who are members of the Responsible Business Alliance. And so this is a code that's embedded in all of our supplier principles. When our suppliers sign contracts with us, they make that commitment to live up to those principles. And that's what we hold them to, particularly when issues come up. So these issues could be any number of things. Sometimes it's people may have their passports held from a supplier, and that's a violation of the rules. And so if that comes up, then we negotiate for people to get their passports back. We don't allow for people to be charged recruitment fees to work with suppliers in our supply chain. So where that's identified as a concern, we then negotiate for folks to get their recruitment fees paid back. So those are the kinds of issues that we deal with when we identify a concern, either through the grievance hotline or through our audit process. We have one of the largest audit programs in our industry. We do per cycle 400 audits a year, RBA level audits per year. So we are continuously evaluating our supply chain for who we deem to be high risk suppliers. That's done every year. And then we do audits of both high risk and medium risk, depending on how that assessment is done each year. So we have initial audits, closure audits. We also do unannounced visits. So there's a very robust system in place to continuously audit our supply chain to identify areas where there might be issues. And then, we work with our suppliers to remedy where that's possible. And where there is no remedy, we work with our procurement teams to develop an exit strategy. So all of that is part of our sort of audit process to make sure that we're living up to the supplier principles and commitments that we've made as Dell.
Yeah, I think that is a good start, unless there's
Unless you want to do a few more minutes.
Yeah, so let me just take out a couple more things just for, so we also do, out of my team, in addition to all of that, we do
which is a lot.
responsible minerals. Our responsible minerals initiative is also run out of my team. So basically, as a global supplier, we are regulated by Dodd-Frank, which requires all companies to submit the smelters and refiners, SORs. I was about to use the acronym, sorry, so I paused.
Good, thank you.
So smelters or refiners in our supply chain who are sources of tin, tungsten, tantalum, or gold, referred to as 3TG. As part of that process, we have an annual process of auditing the suppliers in our supply chain that have products with those minerals in it. And so then they declare to us who their smelters and refiners are. We declare that to the federal government. And where a smelter or refiner is found non-conformant through an audit process, we have signed on to the Responsible Minerals Initiative process. So where they have found through their audits that a smelter or refiner is non-conformant or has some type of violation, we then ask our suppliers to exit that smelter or refiner so that we can be sure that we don't have smelters or refiners in our supply chain that have had some type of human rights or other forced labor violation. So that's something that is also run out of my team. It's also part of the whole conversation. But anyway, I'll get more information later. Thanks.
Well, that is huge, and I mean, this is music to my ears from a business and human rights course perspective. We're doing the extractive class tomorrow, so if you want to come back, we're doing conflict minerals and all of that, and we just covered recruitment fees. These are really hard issues, folks, and Dell is one of the best companies it's been earliest companies trying to go through the entire supply chain. And on responsible minerals, it's really tough with the smelters, et cetera. But they will be ready, unlike many other companies, when the European due diligence directive comes in. And you are CSRD, if you don't know what it is, and you haven't taken my class, look it up, because and that's the reporting one. There's also the corporate sustainability due diligence directive, which is not out yet, but it's going to be asking companies to have a totally transparent, mapped out supply chain, checking it, and if they find something, as she was saying, you actually remedy, and you have to set up grievance mechanisms according to the UN guiding principles on business and human rights. So this is music to my ears. Dell has been a shining example. Now, we're going to pivot to what the hell is happening in Congress. Bryan, all this is well and good, right? Like, how could you be against any of this, right? ESG, we care about the environment, we do care about human rights, and governance is sort of important at the end of the day. That's sort of what holds it all together. So why, first of all, maybe you could talk about the change in understanding about ESG, but you're the one prowling around the halls of Congress. What's happening?
Well, sometimes in the office, before I jump in, we joke that these guys have the easy job in the world. Just have to make money and all that simple. Thanks, Nina. I'm Bryan McGannon, Managing Director at USCIF. USCIF is the leading voice for sustainable and responsible investment in the United States. We are an industry organization. We are a Big Tent organization in the sustainable investment field. So we have members who are asset managers like Calvert, who's been one of our core members for the beginning of time, to asset owners who are like foundations and pension funds of investable money. We've got financial advisors. We've got data firms like Sustainalytics, Morningstar, Bloomberg, those types of firms that provide data for the finance industry. And we also have community investing organizations as part of this big tent of sustainable investment. And then kind of the buckets of work we do, we do research. If you go to our website, uscif.org, you'll see our trends report comes out every 2 years. And this is one of the only reports.
Fundamental reading, guys.
One of the only reports that measures the size of the sustainable investment field. We have an education component. Also on our website, you can find our free retail course. It's a 30-minute online course to understand how to do sustainable investing as a retail investor, which is a really cool thing. We also do it for financial professionals, a longer course, and we have a designation that we've partnered with the College for Financial Planning, so financial advisors can get a designation to demonstrate that they are have the sustainable investing know-how and you can trust. And then lastly, we call it our systems change work, which is our policy and media work, which is where I sit in the organization. And kind of the big picture for us is that policy is a really important role in finance generally, but increasingly for sustainable finance. We don't use a term, we don't say ESG investing, we call it sustainable finance using ESG criteria. Right? ESG to us is data, and it's how you use that data determines whether you are a sustainable investor, which we think also means a lot more to people than this random acronym that a lot of people don't understand. But it really has kind of the field has evolved from a small kind of corner of the finance field. You know, Nina referenced the term ESG coming from the UN in 2005-ish when it was coined. We have members like Calvert and others who have been doing this for decades before that, and largely to meet consumer demand. Used to be the field, you know, was referred to as the SRI, socially responsible investing. And, you know, there was a myth that was already touched on, is that you're trading off value for values. You know, you had to accept lower returns. Sustainable investors have been proving that that's not the case for decades. And so, you know, what we've seen is this massive change. And I think the mainstream conventional finance industry has learned that these ESG factors are material to performance. And they are now, you know, converts, or, you know, for lack of a better term, but wait a second, this is part of the investment process. It's not some nice to do thing, which when I started at USF 6 years ago, it was convincing people that this is, you know, a real serious study. Now the entire finance field, you know, has integrated this into their core investment operations. And, you know, this has been largely driven by the marketplace, this growth. Our trends report we released in December found 8.4 trillion assets under management using a definable, identifiable E, S, or G criteria. We changed our methodology this year from previous trends report. We've done the trends report since 2008. And we used to kind of have this broad spectrum, and we started seeing this kind of real steep growth because the field did grow. But there were a lot of firms that were saying, yeah, we do ESG at the firm, but we can't tell you what ESG factors we're using.
We call ESG.
And so so if you look at our chart in this trends report, it drops off this year because we said, if you can't tell us what you're using, then it's not, you know, we're not going to accurately report the size of the field. So, and that's fine. You know, we think that there's still a lot of learning happening in the finance field about sustainable investing and how to use data to make better choices for the investment. So, you know, we're okay with kind of slicing out those people who just have these broad generalizations. And our colleague organization, Eurosef, just made that same announcement because they're doing a similar study that they're just saying, if you can't identify what criteria you're using, we're just not going to count it. We just don't think that that's, you know, as a field building organizations, that's not good for the field. So, you know, what's happening in Washington around this, right? So the reason, you know, policy, because of the growth of the field, has attracted success and criticism. Some criticisms have been legitimate. Folks talk about greenwashing and companies not doing, you know, saying that they're going to, buying our mutual fund is going to solve the climate crisis, when in fact, you know, up to 20% of their fund has fossil fuel in it, right? So under the rules, that's actually, you know, okay.
But you would have done really well in the last year.
in the short term, the day trader's fine. So, you know, the rules around governing this space really are going to impact the field moving forward. And just to tick off a few things, so, you know, Calvert, and, you know, as an investor on this, I know attests to getting this kind of non-financial information is incredibly difficult to have consistent, comparable, and reliable data, right? That is one of the biggest challenges we hear from our members. USF's been an advocate since 2009 for a ESG disclosure framework at the SEC. And only until this administration have we been able to start that process on a stable. So one of the first rules well, maybe not the first one to come out, climate disclosure for issuers will come out sometime this year. It's supposed to come out this spring. Who knows? Nah, I'm not. Well, sometimes I gamble, but I think that it will. Nothing comes out on time. Is the big picture. But so the climate risk, right? It's a very difficult thing to do. It was they did a very long process of soliciting public feedback to before they wrote this proposed rule. They have issued a proposed rule, and the public gets to comment on this proposed rule. And there is a bunch of conflicting perspectives, right? Issuers who will have to report this say, well, this isn't material to my business, or this is too detailed, or this is not, it'll cost us too much money to have to report this. And then on the other side, investors are saying, well, wait a second, if you're making claims that you're going to be net zero by 2050, we want to understand what policies, proposals you have in place, what mechanisms do you have in place to get there, right? Because CSR report is nice, and we're grateful that companies are doing that more and more in sustainability reports, but those are not audited. They are some companies do much better jobs at reporting what they're doing than others, and there's just no consistent metrics that companies are actually reporting in those things. So we think that a consistent, clear, consistent reporting structure would benefit investors. We also anticipate that there will be a similar proposal for human capital management issues, and those are about kind of employee. It's kind of funny. It's really hard to get consistent information about how many employees a firm has, how many contractors they have, where are the contractors, what are the wages, turnover rates, diversity rates. So that's been another one that we anticipate will come. We hoped would have happened sooner, but we anticipate that the SEC will initiate that. There's two rules that are going to directly impact sustainable investment firms. One's called the names rule. One is called relates to the ESG funds disclosure. So one is about what they name a fund, which is actually incredibly detailed. It's not as just simple as like you can't say this or that. And then there's kind of what's in your fund. So if you say I have Bryan's climate fund, there's you have to have additional disclosures that tell what's in that fund. So consumers and financial advisors mostly can have a better and easier understanding of what are you actually claiming. So the sustainable investing is not just one thing. It's not all anti-fossil fuel. There are strategies that funds have that are best in class that may hold.
That's okay.
All right. So the DOL. Just one quickly on the Department of Labor rule. Speaking of how it's going to impact finance.
Let's put it this way. If you were gambling or having a bingo card on the first Biden veto, I don't think anybody had an ESG rule on that card.
Right. So the Department of Labor governs over retirement plans in the United States, private sector retirement plans. So if you have a 401k, 401(3), 403(b) retirement plan, the Department of Labor sets rules about standards to protect your life savings. It's been a back and forth between administrations, and so Biden administration finally has come out and said clearly that ESG considerations may be considered. So all it says is maybe, so it's a level. So Congress tried to override. If you don't want to go into the weeds, there's a mechanism. Congress can say we don't like this regulation. They passed that. Biden vetoed it, and that was his first veto. And so this rule stands, and now it is a kind of a clear signal to the marketplace that ESG funds may be considered in your retirement lineup. So that's a whole other class.
Or ESG risks may be used if you're a fiduciary and trying to do the best for your clients, and that is totally should be a non-political thing, but it has been. Okay, so we're going to do another round of questions, and then we're going to turn to the audience. Jade, I wanted to ask you, a lot has been said about data, right? And so how hard is it for someone who is in the investment community trying to do their best, especially on the S data, because human rights and all the great stuff that Macani's doing, she can talk about. We're part of all these multi-stakeholder initiatives. We're part of the responsible recruitment. Thank you. But how does that boil down into sort of data that you can use, or do you, for certain, like especially the S, do you just say, look, we engage with companies, we like what Macani's doing, we feel comfortable with the fact that they're going all the way down to smelter, they're really getting they're really going down their supply chain, and that is enough for us?
It's a great question. ESG data is challenging for sure. You are correct that environmental is a little bit easier to work with because it's more concrete. But even then, the data quality, just are they being audited? What is determined in scope 3? Like how kind of verified is the data is challenging. The work that USIF is doing around disclosure is super important and very relevant for investors because sometimes, as folks have alluded to, even the most basic information is not apples to apples. So if you're sitting there looking at, two companies that do the same business, you're not actually always able to get the clear idea of who's doing what, right? There's always asterisks of how they define things and things like that. So what we do at Calvert, there are a lot of ESG data vendors. We cover a broad universe. So we have indexes, et cetera. So we have to leverage the ESG data vendors in order to get, company data across thousands of names. I think if you're a fundamental kind of bottoms-up manager in your, 50 stock portfolio, then you can probably do a lot more digging and dialoguing with companies to try to get the data that you're looking for. But I think, I've been in the field a long time though, and I have seen a tremendous improvement in the data that's available. And there continue to be new and innovative data providers out there that are, trying to put a unique lens on what they're saying about companies. And so Calvert's in a unique position because we can leverage different data vendors and understanding the viewpoints that they have, because each data vendor has their own methodology and you have to understand that and what is their perspective on climate transition or different risk exposures. There's lots of nuance, but being able to kind of put those together, you can kind of almost like have that mosaic of a perspective on a company. But anyway, long-winded answer to say that ESG data quality is really challenging, and I think the efforts to kind of provide more disclosure in a uniform way will go a long way to helping investors do that. And also level the playing field for companies like Dell that are doing a tremendous job and being really transparent, and then, their competitors not. So, it's not.
So I have a follow-up question after we get through is, I've noticed that there were a lot of tech companies in the ESG funds, and I just wonder whether all of them really should be there, because they certainly buoyed up the ESG market for a while. So that would be at the end. Macani, you all heard that Dell is already doing scope 3 emission data analysis and getting all that information for people like Jade. That's really, really the hardest. And so many companies are saying they can't do scope 3 is beyond their remit, apart from oil and gas companies that sort of can't push back on that. But I was wondering whether you can tell us, I know you had some more points to make, but also how you work with the investor relations team in terms of packaging or getting all the data to people like Jade so that they know about all the good work that you're doing.
So there is a separate team, so it's not within my team, but within the constellation of Hub and Scope, we have some members who are responsible for investor communications and relationship management. So I've been pulled onto a number of calls actually to talk about our supply chain emissions reduction program with various folks who are interested, explain what we're doing, how we're doing it. And that's an ongoing process of communication. One thing that I found being in this role is that communication is critical. Yeah. And in some ways, I think there's a lot that as Dell we share, and we do a lot of very good, proper due diligence, but we're actually not sharing all of our stories. And so sometimes we'll see some ranking and say, oh, wait, hey, that's not fair. And somebody will say, well, did we tell them that? Did we tell them all the good news? And so I think it's a continuous process to also double check of, oh, are we actually sharing all the good work that we're doing so that we can get credit from readers and rankers and, from investors for the work that we are doing and the due diligence that we are doing that is robust and timely. And I would echo your point about harmonization. Companies like us benefit from harmonized standards.
Yeah.
Because even if you take, questions around like a product carbon footprint and some life cycle assessments, there are different ways that you can calculate the emissions from your products or from your supply chain. Everyone is doing it differently. Like there are no two companies that are actually doing it exactly the same. So when you see the numbers, unless you're really, really super sophisticated, it's very difficult to actually compare the emissions numbers in an apples to apples fashion to figure out which part of scope 1, 2, or X percentage of scope 3 is actually in scope for their target. Because they're not all the same, even just in terms of the target definition, not to mention the numbers that they're actually reporting in their ESG report. It's very complex. And so, for us, where we could at least know that there is a standard way of doing it or that we're meant to report, we think we'd have an advantage in that context because we're doing really good stuff under the hood. And we want to ensure that when comparisons are made, that they're made in an apples to apples way versus just saying, oh, that number is bigger, that number is smaller. Well, the two numbers aren't the same. And right now that makes it very difficult to do comparative assessments.
Great. Thank you. Thank you very much. Now, I wanted to ask Bryan to talk a little bit about this new caucus that's been created, because you have to have a strategy to push back against this woke capitalism backlash. So just wondering if you can talk about well, it's a thing. Unfortunately, I've been listening to right-wing radio for over 2 years about this, and it's come upon us. So about the caucus and what you're seeing in terms of proactive measures to explain to some of the governors and pension fund managers of some of these, anti-woke states on ESG.
Yeah, so we brought an idea to a couple of members of Congress about this idea of caucus. So in Congress, they have caucuses, which are basically kind of like clubs that have a theme around them. It's Congressman Juan Vargas from San Diego and Sean Casten from Chicago are the co-chairs. They both sit on the Financial Services Committee, and both have had an interest in sustainable investment in a variety of issues on human capital and climate issues. So they were natural leaders. So the point of the caucus is it's an opportunity to educate members. They will grow the caucus. I think there's 15 members now. And this, we launched it 2 months ago. And they are inviting staff to do briefings to understand. USF provides member firms to come and talk about a variety of issues on sustainable investment. And because it's even bigger than the anti-ESG pushback in Congress. There's constant need to educate members of Congress. Their staffs have 1,000 things on their agenda. So this has been it's a really important vehicle to help share knowledge with Congress, because a lot of this the attacks on ESG are not based on facts or political notions and political ideas, and they don't understand how these firms are applying ESG factors to make better business decisions.
Yeah, or telling pension funds what to do. I mean, which for right wing is original, because the whole idea is for government to stay out of your finance and your lives, and that gets us into a whole bunch of other issues. So on the tech, and then I have a question for Macani, which is on this S issue, because I work with some investors as an ESG advisor. One of the things that happened in May, as you may know, when the draft Dobbs decision was leaked, the question was how this is going to impact a number of the companies in some of the what I would call abortion regressive states, or whatever you want to call them, reproductive rights regressive states. How this is going to impact these companies, and Dell is based in Texas. So you're in the sort of in the hot seat. So we'll do the tech company and then a tech question, then Macani, and then, if you don't mind, we're going to open up for questions because I'd like to end at 1:15 if possible.
So your question was that why
Do
some
tech
ESG
companies like do some of these tech companies like Facebook and Google, let's call it Meta and Google, do they even be in an ESG fund?
So we actually don't hold Facebook.
Yay.
Just so you know.
Or Amazon?
We do hold Amazon, which is constantly debated.
Mhm.
So, often when we're looking at companies it is relative to a broader universe.
Mhm.
And so tech companies, if you want to talk really broadly and not so company specific, they do, if you're thinking about financial materiality, their big issues are really in, how are they managing their human capital?
Mm.
And they do tend to, offer, everyone knows about like the soup, they have cafes and, all the different things.
But they're gig workers a lot.
They do because they need to innovate, right? So they need to attract like the biggest, the best and the brightest and try to keep them there. So and then I think their environmental, they're not as like a heavy industry, right? So there's less to kind of like penalize them on. And actually they get a lot of credit for some of their clean tech opportunities, right? So like participating in the energy transition. So very broadly, that's why they tend to be there, to have kind of more of a prevalence in some of the ESG funds. I would also say a lot of them are huge market cap names now. And so if you, from a portfolio management standpoint, need to have certain exposures to areas. And if you're not holding Google, you're really betting against the benchmark in a significant way. They're not perfect companies by any means. And so we certainly do debate, these companies are, their issues and all of that.
Yeah,
But
these are difficult questions. You have Tesla?
so we do have Tesla for the environmental, but we actually don't hold them in our DEI funds.
Oh,
Because
what happened to the ad?
Okay.
Well, so one thing I haven't talked about is Calvert has a really strong engagement program. So we engage with companies. So they have actually, we've had a long engagement with them, particularly on their S issues. And so some of our philosophy is that if there is an opportunity to help companies change, we want to be part of that positive change. And so we'd rather stay as an investor and have that opportunity to work with them. And so we actually have had some success with them, particularly around sharing some of the EO1 data and all of that. But certainly, yeah, another name that.
Well, that's an important, I'm glad you brought up engagement. Engagement is huge, and a lot of social responsible investors remain invested, or small investment, in some of the fossil fuel companies so that they actually can bring shareholder resolutions, which is a whole other thing we haven't talked about, but that is a pressure point. So if you don't engage, it's sort of hard to sort of effectuate change. So I'm counting on you and Elon will be having these conversations over Zoom or wherever, but we'll call you back in a few years and see how that goes. Now, Macani I asked you a really tough question, so you don't have to answer it, but just for, it's all companies based in Texas and some of these other states, it's been tough. We talked about the pressure put on Coca-Cola and some of the other companies in Georgia on voting rights, to stand up for voting rights when there was that whole discussion there. And those of you who may not be following what's happening in Florida with Disney and the Don't Say Gay and LGBT rights and the fact that employees, and that is a really big point, employees are starting to step up and say, hey, CEO, hey, whoever's making the decision on with companies, you need to represent us. But there's trade-off, of course, because then there may be some problems in terms of your market share. So there are these tensions. So just, Macani, from the point of view of a very upstanding, amazing company that's doing all the right things abroad, what are you doing in terms of getting prepared for how how the row question is affecting the employees in Texas.
So I actually
Hmm.
don't know.
Okay.
Is the short answer. I live in Maryland, so I'm not.
Thank God.
I don't live in Texas. I'm a remote employee, and I don't think there's been any public statement made on this issue specifically. It's tough for companies when there's so many public issues at play to decide when to make a public comment or not to. But I can say that we're a very large company with 117,000 employees, and so human rights policy, employee policies and such aren't necessarily dictated by one state or another. They're done in such a way that they comply with national laws and all applicable laws. So that's all I can really say to that. I haven't seen any language otherwise. That said, just to pivot a little bit, what's important for us and the message we want to get out there is our larger commitment to sustainability. And as a company, we want to sort of reiterate, for the things where we have done the assessment of what's most important and core to the mission of what we do. We want to make sure that we're getting our message out there. And so for us, as sustainability, that means, making sure that we're advancing our emissions goals, and that includes a 2050 net zero goal. It includes an emphasis on circularity. For every product the customer buys, we're going to reuse or recycle an equivalent product by 2030. By 2030, 100% of our packaging, actually when they hit this target in about another year, 100% of our packaging will be made from recycled or renewable materials.
That's it.
So we're focused on circularity, we're focused on emissions reductions, and this is what really is core to our advancing sustainability goals. As part of our, the other, just to mention, there are 3 other parts to our ESG pillars. So the second is cultivating inclusion. By 2030, we aspire to have 50% of our global workforce and 40% of our people leaders be women, or people identify as women. Transforming lives is our 3rd pillar. We're hoping to touch 1 billion people by 2030 with our technology. And we also have a commitment to upholding ethics and privacy. So these 4 pieces are the core elements of what we're doing on the sustainability front. And that's really the message that we're trying to get out there.
That's fantastic. And circularity, we didn't talk about enough. And you touched on a huge point, which is how feminized this, how many women there are in this field. And I did want to sort of end with that when we finish our round of questions, because for someone who's been going to US SIF meetings, this is a space which is attracting tons of women, maybe because they're attracted to the human rights, the environmental aspects, not that men are not, but it is something that speaks very fundamentally to a lot of women. So I've been thrilled to see in companies, there have been more and more chief sustainability officers that are women, more women, a lot of women in the ESG investing field, and even at USIP. Let's open for questions. That Roe v. Wade question is, however, I would just say from an attraction, a talent attraction and retention issue, it is a big one for companies in those states. So it is one that a lot of companies will not be able to tiptoe around. But anyway, questions? Yeah. If you can go to the microphone in the back, I think there's a microphone right there. You could just pick up. Is there someone here to help us? I suppose there isn't, but there's the microphone back there. Is it working? Yeah, thank you so much. If you could give it to, well, it was this person here first, and then do you want to ask a question after? Okay, thank you.
Thank you so much.
Are you a student? To give your name. And
Okay, my name is Shingo Kinugawa. I'm the student
Wonderful.
from Sumitomo Corporation, one of the largest trading company in Japan. Thanks for sharing the great insights. Actually, the carbon neutrality is one of the biggest challenges for Japanese companies as well. As you know, we have a lot of challenges for the source of power, especially for nuclear. But all of the Japanese companies now are aware of the importance of carbon neutrality, and one of the biggest challenge for us is how to achieve or how to reduce the category 1 scope 3, so the reducing purchased products. What I'd like to ask you is how Dell supports or urge or incentivize your suppliers, especially tier 2, tier 3 SMEs, which has a more significant problem to reduce their emissions. So yes, how can Dell support them or incentivize them to reduce their scope 3 category 1 emission? Thanks.
So, I mean, the first step for us is just education about, you know, what it takes to set up a program to even work with your supply chain. The renewable energy marketplace in particularly Southeast Asia is incredibly nascent. So as we try to encourage our suppliers to switch to renewable energy, we and the rest of the industry are driving up demand for something that actually isn't there right now. So part of, you know, what we're planning to do is to work with policy organizations like RE100 and sort of other collectives to encourage governments to put in place the policies that will make it easier to develop and scale the renewable energy markets across Southeast Asia, where a lot of the electronic supply chain currently resides globally. So I think that policy work, that collective action and partnership is going to be an important piece of the work ahead to have larger scale impact, not just for the suppliers in our supply chain, but, you know, given that there's a lot of overlap between ourselves and our competitors, that we're all sort of in a pre-competitive manner working to ensure that these renewable energy markets and access to the technologies necessary to build them exist and are easily scalable. So I think that's going to be the difficult road ahead, but the critical path to make sure that you know, tier 2, tier 3, and the rest can participate and be able to address their emissions reduction.
I should add that Japan is actually really starting to put great focus on this issue and has put out some responsible business conduct rules for companies through their National Action Plan, which the U.S., by the way, talk about waiting. We're still waiting for the second U.S. National Action Plan on responsible business conduct, but these guidelines are very helpful for companies so that they understand what is expected of them. So that is a very positive development.
Thanks so much.
Okay, back there, and then.
Hi, my name is Chaitan. Thank you so much for being here. I'm a current student at SAIS. I wanted to have you all take on, you know, maybe the heart of the anti-ESG argument and really decompose how much of it is myth and how much of it is like there are kernels of truth. You know, my understanding of part of the like attack on woke capitalism and Vivek Ramaswamy and the whole movement is there is a lack of consent for private investors who don't want their money to go towards social aims that they don't necessarily agree with, and B, that there is a fiduciary gap between what the asset managers are doing, not with their money, but with other people's money. So just, I don't know who wants to take this on, but is there a kernel of truth in either of these arguments? And if so, and I think they will retain their salience for half the political spectrum for the foreseeable future. So
Maybe Bryan, you can start with that one.
Sure. Well, look, the attacks I think are largely politically driven, and I think that they're searching for a financial justification. You know, there are thousands and thousands of products on the market. Don't buy an ESG product if you don't care about social issues. Just don't. It's a nothing burger, for the lack of. That's a Washington term. So I think that challenge doesn't exist. I think that on the fiduciary standard, I think it's, you know, it's proven that these issues are material to the performance of companies and performance of investments. So, you know, I think that there's a conventional wisdom that, oh, in the last 2 years, oil and gas, fossil fuels have done really well. So that proves that ESG is a bad investment. Well, if your time horizon look back to 2014, fossil fuels were a stinker. Like, they were terrible investments. So, and if you're also forward-looking, we know we're going to live in a carbon-constrained world. Why not make investment today? If you're holding, especially if you're a pension fund, if you're the state of California or the state of Texas, you need to protect that investment. You really should be factoring in what the world is going to look like, what the rules will look like, what the just these are material factors that are in place today. Also, I think going back to that first point of if you don't, there's no people aren't aware of what the they don't want to buy into the social constructs. ExxonMobil has a fantastic diversity plan, and they're really strong, and they brag about what they are because they want to attract talent, right? They want to attract the best talent. So I don't know if Vivek Ramaswamy would want to say that it's in his portfolios. So if you look at oil and gas happens to be really strong on S issues, on the kind of the human capital side. So I just think that there's look, you've got choices in the marketplace, and I also just think that for the most part there is kind of a oil and gas push behind this anti-ESG thing with
I'm sure there's a lot of money there.
Attack to undermine capital flowing to different directions.
Yeah, anybody else want to comment on that, or, well, okay, so there's a question here, and then a question there, and a question in the back. All right. Yeah, I know. Yeah, nope, right there. Thank you so much for helping. I don't know if this is part of your remit, but I appreciate it.
First of all, thank you for being here, and thank you for sharing the views and definitions on ESG as well. I attended a lecture on Zoom last week on ESG from a Warren Buffett follower who's written on Mr. Buffett a lot, and he more or less indicated that the ESG movement, more specifically the social and governance perspective, continues to face or now faces resistance as a result of shareholder performance. And he showed a number of graphs indicating that, in fact, shareholder performance has diminished as a result of ESG. As Connie indicated, however, he just showed an overall chart. He didn't necessarily go into specifics with respect to data, but again, there was a significant gap. So I guess my question is, with respect to the tensions regarding shareholder performance and governance, could you address those issues and also throw in the concept of risk with respect to more specifically the S and the G factors?
Maybe we should Jade and Macani and Jade, yeah, both
or
of you. I
Jade,
mean,
doesn't matter.
Macani, why don't you go for that?
More or less specifically, but like I said, the factor of resistance to that.
So I'll let Jade speak to the resistance factor because I'm shielded from that where I sit. But here's what I'll say in terms of the general risk calculus. I think it's easy to underestimate the amount of risk that companies take when they don't build sustainability into all aspects of their decision making and risk analysis. And this goes to, because when you take, for example, forced labor issue, when forced labor issues, pop up, if they're not dealt with adequately, that's a brand risk. That's a stakeholder risk. And that's very serious. And it reduces stakeholder value when companies don't take those issues seriously. So investments that are made to ensure that the supply chain is a safe place to work for workers, and that there are standards that are kept, drive stakeholder value, drive shareholder value, fundamentally. Taking into account changes in climate patterns, flooding, desertification. I mean, those are issues that fundamentally affect the ability for the supply chain to deliver. If factories don't have water, they can't produce. If you know the factories aren't going to have water in 20 years, you probably need to make some different decisions about sourcing. Companies that are not taking into account changes in climate in terms of projecting how the business needs to shift to accommodate that, we'll lose, and that will affect shareholder value. So someone who's standing externally and just pointing to some number and saying, oh, you invested X, but I don't see it in my Y, is failing to understand the internal dynamics and risk decisions in every part of the business that need to take into account sustainability issues. This is core business, these are core business principles, and telling companies that they shouldn't be spending money to address core principles is incredibly short-sighted.
Yeah, I mean, I think you just said that perfectly, because I think there is the resistance and maybe the misinformation about is that it's some side project or something. I mean, these are core to companies, positioning, how they're going to make the best decisions for the long term, and all of that translates into shareholder value. And so I think, there are going to be market cycles. We've seen that in the last 2 years where many, because we haven't had as much exposure to fossil fuels, where performance has underperformed. But if you look over the longer term and over, as Bryan was saying, forward, I think that the graph or whatever might look very different. And we've done a lot of research when we develop our own kind of metrics that we use in our portfolios, and tested them to understand if there are signals that are connected to stock performance, and have found that there is evidence of alpha when you are considering diversity, inclusion factors, when you are considering governance factors. And so, we always test the factors that we're using before we use them, for this reason of fiduciary responsibility.
And one, addressing the G issue, I mean, I think that we haven't talked much about the G issue, but, kind of, you have, the dual class share structures where the CEOs of some mostly startup companies have an inordinate amount of control of the voting shares. And I think you look at, a Tesla where, you've got a CEO who maybe is spread too thin. These are risks. I mean, whether he's doing it, he can succeed at it, I don't know enough about it. But to an investor's perspective, that is a risk that he's either not spending enough time managing the 5 or 6 companies he owns, and there's very little recourse from investors because there's not enough. He controls voting shares to not be able to have vote. And then with the other point with the is that there's a lot of investment philosophies, and it's not to say that what you heard was a bad investment philosophy. It's a different philosophy, and I think nobody in the sustainable investment field is saying you have to do this. Businesses are saying, man, this makes good business sense, but there are a variety of philosophies, that any person can be free to pick along the way.
Yeah, I mean, I would just echo, there are people might want to be in growth style in one market cycle, another, and we think of it in a similar way where it's just another style of investing.
Thank you.
Yeah, because there's a question back there, here, and then there, and we'll close it out. Yeah. But just to say, Dell is prepared, right? I mean, Dell is not going to be caught unawares by any of the regulatory risks, any reputational risks, because they're on the ground, they're dealing with it. They've got a social license to operate, they care about the human rights aspect, the environmental aspect. Companies that are just not doing that are going to be, at some point, they're going to pay the price. It's just a question of when, not if.
Hi everyone, my name is Aishwarya. Thank you so much for being here. My question is on double materiality, specifically to Bryan. What is your stance on double materiality? Do you think ESG is enough, or companies and investment vehicles should start looking at impact materiality? And also specifically for Jane, because you mentioned so much about financial materiality. Do you consider impact materiality? And if you don't, would you be considering it in the future?
Yeah, that is a fantastic question, and it is a very core question in our membership. We don't have a clear answer yet. We have a range of members who, so just folks, if don't know, there's kind of the concept of single materiality, meaning how do ESG factors affect the individual company and their performance, and double materiality says how does it affect the performance as well as external audiences, whether it's the environment or communities, the bigger picture. So we have firms in our membership who have very strong opinions that it really is about this kind of enterprise level considerations, and that's what the focus should be, and that's what investing is delivering performance. And we have a lot more. We have other members who say, "Wait a second, we need to be measuring the impact of these companies on the rest of the world as well," and that was where we should be focused. Now, it is that is kind of a very nascent space of measuring impact. I think that will be a much bigger part of the dialogue in the next 5 years, as measuring impact. I think that this is kind of where the greenwashing critique comes in, is kind of if you're sitting in between those two spaces, someone may assume that you've got an ESG fund, therefore it is actually affecting the world, but it's actually, in reality, it's just looking at the companies. Now, changing the company's behaviors to do better also can help and have an impact, but it's measuring kind of two different things, and it really is kind of the crux of where our field is right now, is kind of in that understanding that.
And Europe is moving much faster on materiality than we are. Jade.
Yeah, no, I mean, to that point, Europe has new regulation out that you need to consider, these impacts depending on how you label your fund. So it's something that we actually grapple with. And I think at Calvert, we certainly believe in double materiality, and we are increasingly wanting to factor in impact, which is different than financial materiality. And so it's a different lens to wear. But as Bryan said, the data is really challenging, right? Because it's hard to demonstrate an impact on ecosystems, right? Biodiversity obviously is a huge area of interest. The data is just really hard to be able to apply to an entire portfolio to say this is our, biodiversity impact. So while we want to do it, we're trying to the data is really challenging. So we have actually we are putting out some new impact reports across some of our funds. But again, there's the data to make it more robust and really interesting, which, I want to know how many, lives kids are getting educated by we just don't have the data to be able to really stand by that at this point. But it's certainly something that I think will evolve quickly too, because that's what the marketplace is looking for.
Thank you. Last question, then we're going to close it out because we have wonderful panelists with very busy schedules, and I promise to release them.
Can you hear me?
Yes.
All right. Hi, my name is Owen. First of all, thank you all for being here and sharing this time in this room with us. So Tina, it's more of a question for you. I'd like to pick your brains a bit. So I've noticed the theme of perspective, especially with you guys up there. We've got an investor perspective. We've got more of a practicing perspective. We've got an education and also a political. Now, I am curious if you could kind of summarize the goals or challenges that unite all these perspectives into one resounding voice that will, get President Biden to say ESG will be included in 401ks and, more worldwide adoption of ESG.
Well, we can close on that. Why don't we just go down the line on that? Although I don't think the idea is for government to tell any fiduciaries what to do. Hopefully, the markets will go their way. But I figure that's what Jade.
Yeah, I mean, I think that it is fiduciary duty, the consideration of some of these non-financial areas, but that it's choice, right? So you as an investor can choose the funds that you want to invest in, just like, whether that's ESG included or not. But I think that there's a principle that I think is proven out and starting to get more accepted, that the consideration of these issues is part of consideration of fiduciary duty.
Yeah, I'm trying to think about your point about the one consensus voice. So that's tough to say. I think, in terms of the through line that I'm seeing, across this group is that, ensuring that companies are honestly communicating about what they're doing I think is critical so that, having transparency so that we can fairly compare what one company is doing to another is important. Now, what that means and how complicated that is, we'll have to leave that up to the regulators. But I think the fundamental notion of transparency so that we do avoid greenwashing and that kind of stuff, I think is critical. One concept that I didn't touch on is this notion of the Science-Based Transparency Initiative. That's the organization that vets that for those of us who have made commitments to reduce emissions, that the math actually makes sense. And they're looking at everybody's math. And if you're SBTI certified, it means that, there's a chance that you'll make it. So, our goals are SBTI certified, and we're pushing, one of the things we're doing for our supply chain is asking them to become SBTI certified as well. It's a significant investment. So the smaller guys won't be able to do it in the short term, but in the longer term, it forces everybody to make the kinds of investments that lead to greater transparency and consistency so that we all are meaningfully working towards emissions reductions. And, we only have one planet, and we see it as our collective responsibility to do what we can to make sure it's survivable for all of us.
I want to just build on that because, efficient markets work best when there's transparency and information, right? So I think that is kind of one of the biggest, challenges that we all face. And government has a role to set those guardrails, but I think it is up to the marketplace to kind of solve kind of the investment side of this and live up to the fiduciary duty. There's a role for government to solve systemic problems. Like the governments do need to step in and do take on the climate challenge. The finance industry can do its part, but it is not the finance industry is not going to solve these major systemic problems. But they like every segment of society, they have a role to play, an important role. But I think that the transparency and honesty and clarity, there's a lot that falls on our industry to be transparent about what's in the products our members are selling, just as much as we want to ensure that the companies are being transparent about what their policies and processes are.
Terrific. And from my point of view, I'm just saying this is a terrific panel. I'm trying to get students to understand how important human rights and environmental issues are, as well as governance. Many of you are picking those things up from your various courses, but it can make a huge impact whether you're working in civil society or in an industry group or a company or an investor group as a fund manager. This is where you can make a real difference. There are a whole bunch of new jobs that didn't exist when many of us went to school. And this is where the future lies. I believe, obviously, we are also making decisions every single day as consumers, right? And so companies are, if you decide to buy Dell, you make a decision, Dell is really doing that good work throughout the supply chain. You're going to may prefer Dell over its competitor, for example. Or as an investor, if we have transparency and you actually know properly and governments mandate certain rules which you have to report about, you can make decisions as investors. All of that is going to help us get to what we hope is a better place, because I will close with saying when it's 86 degrees on a day like today in early April, you really have to wonder what the state of our planet will be in 10, 20 years from now. So we all have to do our part. So thank you very much for attending, and good wishes to all of you.